Hi everybody, my name is Ankap Ramjetsab, and today for T-Tech section, we're just gonna go over the real estate 1051 FAST IAST enhancements that we did for contingent rent index rent and additional costs and income. The agenda for today, the first topic is the contingent rent or index rent that we do in 10.1. We're just going to go over to the key information. Also talking about the current accounting standard impact. And we're just going to go over the application changes that we did. The second topic is the additional costs and income. The costs and incomes that we're talking about are the initial direct costs, rental prepayment, and the tenant improvement incentive. After that, I'm just gonna demonstrate how to set the index lease and activate it, and also how to use the index adjustment calculator. And we'll see the impact of the impact to the current accounting standards. After that, I'm just gonna show the example of the additional cost and income and how to set it up, and then go activate it, and then you will see the result and the impact of the new accounting standards. And in this PowerPoint, I also included the release notes and references for your further guidance. The contingent rent, the definition is that contingent rent or variable lease payment is the amount that is paid as part of the lease payment, but is not fixed or agreed in advance at the inception of the lease. Rather, the amount to be paid that is dependent on some future events. For example, the contingent rent based on the price changes, or maybe the inflation index, which we know as the consumer price index. The key information on the straight line schedule. The current FAST IAST accounting standards, the contingent rent is excluded from minimum lease payments and are accounted as expense in the period in which they are incurred, which is called the variable lease payment. The lease payment that is dependent on the existing index or rate, such as the consumer price index or the prime interest rate. It will be included in minimum or 12% lease. Note that 10.1 covers changes for the contingent rent related to the current accounting standard for FAST IAST only. The impact for the current accounting standard for this 10.1 release, we apply the minimum percent to the rent, first of all, and then we can now adjust the payment through the index adjustment calculator based on the adjustment frequency that's set on the index clause. Then system will adjust the payment starting from the start of the adjustment frequency to the expiration of the lease. Last, the FAST IAST, the net rent payment is only impacted by the application of the minimum percent. The contingent rent or the variable lease payment amount will need to be calculated outside of IBM TRIRIGA. The changes that we've done, we have done for the application side, is that is on the payment line item. A new field is added to capture the minimum adjustment amount, as you can see in the screenshot. On the index adjustment calculator, the end date is now defaulted with the lease expiration date instead of the end date of the adjustment frequency that is set in the index clause. For the fiscal line item, the amount of the net rent payment will be included with the minimum percent applied. For the next topic is the additional cost and income. The first cost is the initial direct cost. They are legal fees, commissions, executory costs paid by the lessee to the lessor. These costs need to be included in the asset value for operating or finance lease on the inception of the lease. The second cost is the rent payment, rent prepayment. The rent prepayment is the rent that paid prior to the rental period. The tenant should record on the balance sheet the amount of the rent paid that has not yet been used. It needs to be included in the asset value for operating finance lease on the inception of the lease as well. The third one is the income. It's called the tenant improvement incentive. It's the income that's paid by the landlord, or incentive that's paid by the landlord to the lessee for some improvements. Typically, it's a one-time payment. Future tenant improvements income is reduced from net rent payment in the period it is paid. The total rent overall will be reduced if there is any tenant improvement incentive. The incentive amount past and the future are reduced from the asset value calculations on incentive on inception of the operating finance lease.
So all these additional costs and incomes are impacted for the current account, for the new accounting standard?
Yes, only for the new accounting standard.
Cool. Thank you.
Now we're just gonna demonstrate the index-based lease and also the lease with the rental prepayment, tenant improvement, and initial direct cost. For the index lease, I'm just gonna show you the mock-up Excel sheet that we have done and verify with while we do the development. Then we'll just I'm just gonna show you how to set up the index clause, apply the minimum percent, and then issue an index adjustment calculator to adjust the payment. And then we're just gonna look at the impact to the straight line schedule of the current accounting standards. Okay, and then we'll come back to the slide. So now I'm just gonna go over to the Excel sheet. This is the Excel sheet that we mocked up and then used to verify when we were doing the development. So my lease is, for this example, my lease is starting in August 2008 and then run 10 years until 2018 July. And each month, the base rent is set at $20,295.59. And when you see the net rent in my example, after I run the in the product for you, you see that the increase will be starting at this point onward, which is 2010 August.
Which is the anniversary?
No, actually here.
2009.
2009 August, which is the first anniversary. I'm gonna set it up the index cost frequency as annually. Okay.
Is that right side the current one, or this is the current one?
This side is the.
Okay.
Yeah, it's the current one.
Good.
So in the sheet there will be finance schedule or operating schedule. It's based on you know, your lease, whether it's finance lease or operating lease, then the columns will show up differently.
The current accounting standard will show the straight line schedule and amortization schedule.
Okay, I'm just gonna show you how to set it up. the contingent and the index cost and all.
Good.
So I already have the lease created in the system, starting at in August 1st, 2008, and then run until 7/31/2018, which is the expiration of the lease. I have to go and create the payment, which is the base rent of $20,000 and $259 there. So I'm just gonna create payment type equal to rent, and then it will be monthly payment, and then start on the first day of the lease itself, 2008, and with this amount, first day, due on the first day, one schedule, 120 months. There's no goat because it's a base rent. And then you see that it ends 7/31/2018, and I'm just gonna create the schedule. Once it is created, I'm just going back to create a clause, an index clause of rent as well. To create an index rent clause, you just have to see here includes index adjustment flag. So just check that and then populate the index adjustment section. So I'm selecting CPI. The base here would be 2009 for me, 2008 actually.
Mm-hmm.
And then index percent 100. Adjustment frequency, I'm just gonna set it to annually. So I'll get the index adjustment calculator annually as well.
We can do it other frequencies as well, but typically it's annually.
Right. And the first adjustment date, I'd start adjusting on 8/1/2009, which is the second years after my lease started. The minimum percent increase, I'll set that at 3%, maximum at 6%. So the 3% will be applied when I activate the lease, and I'll show you in a second. So just remember this 3%.
Yeah, the minimum is also called as floor.
Yeah, minimum percent is also called as floor. And then after that, I'm just gonna associate the base rent payment schedule into this index clause and then create.
Yeah. So our design here is that we are going to associate one base payment schedule. Although the system allows multiple payment schedules to be associated, our approach is that we want to associate one base payment schedule to an index clause, because any increases to this payments would be happening through the index CPI.
Right. That is done. Now we're just going to go to the accounting tab. So we'll see that accounting start date and accounting end date is now defaulted with the commencement date and the expiration date of the lease that we set in the general tab. And in the fast fee treatment, because this is the gap, which is the fast fee lease, right? So I'm just going to take the building and floor and then click on this calculate lease treatment. So now my lease is now operating. So you see that I'll see the straight line rent schedule, which is just the current accounting standard. After that, we just activate the record, right? So I already have the record created for after the activation, so that we don't waste time waiting for the record to come back to activate. So now I have the same lease created. And this one is already activated, right? Payment schedule is now going to schedule. And for the straight line rent schedule now is populated, created 120 fiscal line item. Started in August 2008 until July 2018. And even though the amount that we put in per month is supposed to be $20,000, $295 and 59 cents, the first year it will just show like that, right? Until September 2008, July 2009. Because that's the first year, it will show the same amount, which is the base rent. But the second year onward, which we said starting the adjustment of the floor amount is the floor percent, 3% on top of that, is starting at this period, which is August 2009. So the August 2009 year 2009 August until 7/10 there, it would just do 3%, which is the minimum floor that we set in the index adjustment clause, on top of the previous amount, which is the rent amount, the base rent amount. So it's 3% on top of $20,000, $295. So now the new amount would be $20,000, $904 for the second year. And then for the third year, which start August 2010 to July 2011, it will be 3% on top of the previous year, which is now, the base rent is now $20,904, which is, this one is the base. So it's 3% of $20,904 will be $21,531. And it will do like this in every single anniversary, right? Because we set up as annually. So every anniversary, it will just do the previous year amount as a base rent and times with the minimum percent that we set in the index adjustment clause, which is 3% in this example.
So every anniversary floor is applied, taking the previous year as a base amount.
Yes. So now the total will be a little bit more than what we see in the payment. You see that $791 there. But if you go to payment, which have the payment line items here, the total will be only $2,435.
Right.
Because this amount on the payment line item doesn't have the minimum 4% applied yet.
Yeah. Basically, the accounting will give you the payment that they have to make considering the floor percentage applied.
Right.
Cool.
So this is the first activation. So now we go back to the payments tab here. On the payments tab, we also can, and then, the payment index adjustment calculator will also send to the user as well, right? As an action item.
Right.
So right now, what I see is the index adjustment calculator that is before today.
Okay.
That is created before today. So each year it will create one. The start date will be at each frequency anniversary, but the end date will run into the expiration of the lease itself. So all the end date of each index adjustment calculator will have the same expiration date.
Right.
So if I open one, which is the first one that I wanted to adjust, you see that the start date and end date will be populated for you automatically. And then now in the calculator section, that's where you would specify what is the new index that you wanted to apply. What is the percent and amount that you want to apply for this period onward. So in this case, let's say we just do 4%, right? For the first index adjustment calculator, you should be using the schedule amount, which is the base rent itself. So the base rent is $22.95, and then what we said is that do the calculate here, and then this is the amount that will be adjusted, added into the payment item. So now your payment would be $22.95 plus that $811 there, which is the 4% that we will be using. And
so basically, they are doing an index, taking the base as 100 and new index as 104.
Right.
And then they're calculating the 4%,
Yep.
out of which the 3% goes towards the floor.
Yep.
And 1% is the variable.
Yep. I'll show that in a minute. So after this, we'll just issue the index adjustment calculator, and then we can go into that record, which I already have it there. So once you have that index adjustment calculator issued, I'll show you here. So the first one is issued with the adjustment of $811.82. If you go back to that payment tab, you'll see that at this point onward, which is August 2009, you have the new adjustment included in it. So it's $22.95 plus $811 in there. So now the new payment would be $21,107. And if I click in there, the change that we did in the application for the PLIs itself is this field, minimum adjustment amount. The minimum adjustment amount is now only captured the 3% that we set in the index cost. But we said the changes is 4%, so the 3% will be captured here, and the 1% left is captured here in the index adjustment amount. So instead of club these two amount into one, so we separate it out, saying that okay, 3% is for the minimum percent that we set, and then the 1% left is for the for the index adjustment amount.
Which is the variable amount for the payment, but which is not, we are not showing that in the accounting. We're not calculating it for the accounting.
Yep. So now this is on the payment line item. So now we're just gonna go to the fiscal line item. So the fiscal line item, there is no change. Like what we said earlier, that the variable lease payment were not captured in the fiscal line item for the current accounting standard. The customer would have to calculate that variable lease payment themselves for this lease.
Okay. So for current accounting for both FASB and IFRS, the net rent after activation of the index adjustment calculator will not change the net rent amount.
Right.
The total amount remains
right.
the same.
The total amount will remain the same as its first activation, meaning it has the base rent and then apply with the 4%, 3% that we set in the index cost. Okay. So those are the things that we've changed for the index rent.
Right. So for the subsequent adjustment.
So for the subsequent index adjustment calculator, you can also activate it as well, and then by using that calculator, instead of using schedule amount here, you should use the last adjusted amount. So like for example, this I would increase to 105 as a new index. So and then check the last adjustment amount. What it does is instead of using the base rent, which is $20,954, it just used the whatever it just last adjusted, which is $21,107. Right. So it should be 5% of whatever last adjusted amount. So now it will become $1,055. That will be adjusted on the payment item. Okay. So the first time of index adjustment calculator using schedule amount, the later times would be using the last adjusted amount. Okay, so now we're done with the first topic itself, index lease. And I'm just gonna go back to the slide. Yeah. Okay, I'm just gonna go back to the slide and then talk about the second topic, the demonstration of the lease with the rental prepayment, tenant improvements, and index adjustment, initial direct cost. I'm just gonna refer to the mockup Excel sheet again. It's a separate sheet. Set up a lease with the additional cost and income, and then we're just gonna go over to the first activation, and we'll see the impact that happens on the operating and finance schedule for the new accounting standard. Okay. So go back to the product. So sorry for the sheet itself. So here is the mock-up sheet of the initial direct cost, the lease that has initial direct cost, prepayment, and tenant improvement incentive. So for this example, my lease will be running from July 2016 and then until the June 2020. The amount of the payment would be $50,000 for the first year. There's a rent escalated rent here. So the first year would the lessee would pay only $50,000, and then second year would be $51,000, and then after that it would just be at the $52,000 onward. So the amount of the initial direct cost, we'll set it at $2,000. The prepayment is $3,000. We'll have two lease incentives. One is $50,000 and one is $10,000. The $50,000 will be given to the lessee at this period, which is November 2016 for $5,000, and another one in July 2017 for $10,000. So now I'm just gonna go back to the product and have this example set up. So first of all, I'll just create the lease with the commencement date for 7/1/2016 and expiration date at 6/30/2020. The payment will be, for the first year, will be $50,000, 7/1/2016. So we rent monthly, 7/1/2016 for $50,000. There'll be 3 payment schedule. Let's do 12 months first, and then just do a fixed growth of $1,000.
Every 12 months.
Yes. And we'll check here 6/30/2017, 6/30/2018, and then my lease is ended 6/2020. 7. create schedules. So when we have the schedule, now let's go to the accounting tab. The accounting tab has the accounting start and end date defaulted already. So now you see this initial direct cost. The initial direct cost we said is $2,000 for this example, and the prepayment is $3,000. So I'm just gonna come and populate that amount. 2,000, then the prepayment here is 3,000. So just save the record for now. And coming back to the payment tab. So now we said in the example that we have two lease incentives, which is the tenant improvement income that we'll receive from the landlord. So just go to generate the payment again, but instead of account payable, now we have to change it to account receivable because that is the income that we'll get from the landlord. So have to change that accounting tab to be accounting receivable here instead of account payable as usual. And then the amount would now be changing to the one-time payment because you only get it once, like you only get it as a one-time lump sum from the landlord. So we said the first one, it will be in this period, 11/1/2016, let's say. 11/1/2016 for $5,000. Pay the schedule.
Payment.
Oh, sorry. I forgot to change the payment type. Change it here. So the payment type would be tenant improvement incentive. Sorry. So that is the first income that we'll get for that period. And then we said we have another one in 7/1/2017, let's say. So change the payment type to be tenant improvement. Change the accounting type to be account receivable. Frequency to be other. 7/1/2017 for $10,000. Create schedule. So this is all we have now. And then we'll go back to the accounting tab. So now we also gonna say it's GAAP, the lease. And I pick the building and land and do the calculate lease treatment. So for the new accounting standard, the lease classification is operating. So what we'll see in the new accounting standard here, we'll see the operating schedule down here on the accounting tab. So after that, we'll just activate the record. So once the record is activated, as what we set up, we'll get this, what we see here. All the payments will go to schedule. And you'll see that accounting tab on the operating schedule. You'll see that on 11/2016, instead of paying $50,000, we only pay $45,000 because that $5,000. Because of that, $5,000 is the tenant improvement incentive that we got from the landlord. And for at this period, instead of paying 51,000, no, 50, yeah, 51,000. because we get 10,000 from the landlord, so now we ended up only paying that period 41,000.
You can also see the total incentives here.
Yeah, the total incentive is also posted here. So now the total amount, the net rent amount, instead of paying on the payment tab here, instead of paying 2,400,060,
Yes, 6,000. It would be.
it would be, wait, this one. It would be only this much.
Yeah.
Because you get the incentive from the landlord itself. So overall net rent is reduced. And yeah, and what is it? And as the initial direct cost and the rent prepayment is also included into the asset value calculation.
So typically, asset value includes the liability plus the initial direct cost plus the prepayment minus the tenant improvement.
Mm-hmm.
So the asset value in this case would not be same as the liability, but it will be, I guess it will be lesser, right?
Yeah, it's
Right.
lesser.
So this Excel sheet.
Yeah. So the formula that we use to calculate the asset value, starting asset value is now this, which is the liability itself plus the initial direct cost minus the prepayment. Oh,
Plus the
prepayment minus
minus
the
the
tenant improvement.
And this on the finance, and the same goes on the operating side,
Yep.
which we showed in the example.
Yep.
And then the asset value, liability value comes down to 0.
Yep. Asset value coming down to 0, liability value coming down to 0. Oh. Go back to the slide. Where is it? How would I show this page only?
Yeah, just go to the
Slideshow
slide from
from
current.
current. So now we went through all these, costs and incentives,
Yes.
and also the impact that happens on the new accounting standard. So, like I said earlier, we also provided the release notes and references. If you want to, go and read, what is there, Kate has been updated. It's heavily in the index assessment calculator.
Yeah.
Index assessment part.
We have release notes coming up for 10.5.1, and Knowledge Center has information about all the lease, real estate lease. And if you are specifically interested in getting to know about index adjustment, we are providing this.
Thank you, Praveen.
Thank you, Anita.
Thanks everyone for listening.